Now to our call of the day. Chevron, you knew that, upgraded to buy from neutral at UBS with a price target of $125. UBS saying the oil upcycle is not reflected in the share price. Jenny and Pete, you both own shares. Jenny, I'll start with you. They say the company is very sensitive, maybe more than any other big company, to price movements. They think prices for oil are going to go up and therefore buy Chevron because also, by the way, they're a very good steward of capital.
Right. This is an interesting call in that it's highlighting what's gone on in the broader context. So if you look at the European majors, right, they're being really forced to move into the next century and get away from fossil fuels. Chevron, meanwhile, has said, no, you know what, this is our business. This is what we're going to do. We're going to produce oil because this is where we are, and we're going to make a lot of money doing it for as long as it lasts. And this is UBS updating those and saying, okay, you know what, we think the average price of oil for the coming years is going to be $75 a barrel. But we know it's about 81 now. We know it's going to be about that next year. And they increased their earnings, and they increased them by about 35% over what they had. I think there will be a lot of catch-up overall. Then what you get is you get a stock with about almost $11 of earnings in the next couple of years, trading at $115 a share. And there's value there. And that's what this analyst is saying. He's saying there's value there. Cash is king, especially in a rising rate world, in a harder to make money world. Cash is going to be king. That's what this upgrade's all about, just the consistency of cash flows that they'll be able to pump out over the next several years.
Yeah, so to speak, pump out. Okay, now, Pete, to be fair, the price target's $1.25, so they're calling for less than $10, right, or what, about 8% in upside. So it's not like this is going to be some huge home run of a call if they're right.
Yeah. But don't forget the dividend,
I agree with you,
so
Sully.
It's 8% plus the dividend.
Right, yeah. Yeah, that dividend is unreal. You look at their balance sheet, it's fantastic. You look at the cash flows that you were just talking about, Jenny, they're absolutely extraordinary. I mean, Sully, you know a lot about this whole world in the oil patch, and so you get it. I'll tell you what, I think Michael Wirth does an unbelievable job and always keeps focus on the direction they're going to. So, yeah, you talk about the 125 price target. I think that's extremely low, especially when you look at the potential valuation of this company and you look at that balance sheet, because with that cash flow, what they choose to do with that cash flow, they make up their own decisions on that. It's not always going back into the development side of things. Oftentimes it's going back to buybacks. It's going back into dividend yield. It's going back into all these different aspects. So I like this company. I love the way they run it. And I think this is a company that not 125. I would expect something closer probably to 135, maybe even a lot higher than that, given that oil continues this path that we're talking about right now.
Yeah, and Jim, they're trying to navigate this really sort of man-on-wire type tightrope act, which is you got to grow a little bit, but you don't want to tick off your shareholders by not giving them the money back. If they put too much money back into drilling, people say, why aren't we drilling more? There's a lot of reasons. One of them is shareholders will hit you in the head with a stick if you do that. They do not want you to spend that money. They want you to give it back to them. What about the macro energy complex? Are you a liker of it?
I'm very much a liker, and while I don't own Chevron, I own Marathon Petroleum, which I think you know well, Brian. That's actually outperformed Chevron over the last 1, 2, and 5 years. I also own Kinder Morgan, which is a little bit behind Chevron, but has a higher dividend yield, so it's almost on par with. And I think the short answer here is that there is going to be a supply-demand mismatch in favor of higher oil prices for probably the next year. That's not going to get solved until either OPEC starts pumping more or domestic shale producers start pumping more, neither of which looks like it's going to happen anytime soon because of exactly what you just said. These managements, they already have activists on their board in some cases, and they want to keep their jobs, they want to keep their share price high, and they know if they start spending too much, share price goes down.
And I can say, Joe Turno, without getting into the politics of it, you know, we're doing a lot of OPEC blaming, and I understand that they're an easy group to blame, but knowing OPEC as well as I do, the more you blame them, the less likely they are to add probably more oil to the market. I'm just throwing that out there as well. Are you an owner or a buyer or a watcher or a seller of any of these oil and gas names or anything in the energy complex, by the way?
Well, I own PXD and I own Cheniere and Joe T. I will say this about energy. It is in the midst of a secular paradigm shift. That paradigm shift is represented in the actions of what Mike Wirth is actually doing. There's no incentive to increase production. The incremental revenue that's generated is going to be returned to the shareholder. and on the improvement of the balance sheet.
It's well said. I think it's the most interesting space over the next 10 years to invest in. And by the way, Cheniere, LNG being shipped around the world. The world is in huge demand for U.S. liquefied natural gas.